Hey everyone, welcome back to the Mike Rosehart Show. We're live again, and this time again on the road in Florida. 10, 11 days now here in Florida. Getting ready to go back to Canada soon. Got my brother all set up. We're doing a flip project down here. Spent the last couple of weeks developing some great relationships with some great wholesalers and some great realtors here that have a lot of off-market bird dog type stuff. So it's been good. I don't know if the internet's any good tonight. We're at a hotel that honestly it was a bit cheap, and so I went with the cheaper option. And the Wi-Fi is here up on the third floor, so it does have a nice pool and it does have a nice spa and stuff. And we just had a nice bit of food there at the Cracker Barrel. So I don't know if it's loading or not. If you can hear me loud and clear, let me know. I probably shouldn't stream in like 4K. I should probably try to lower the resolution somehow, but I don't know how to do that while I'm already live. So it is what it is. Fortunately, the new iPhone 13 likes to stream in super high quality. So I could flip it the other way and then it would be lower resolution, but whatever. Here we are. Today was a crazy day. I didn't really get a chance to check the markets a whole ton, but did you guys follow what's been going on? So you guys know I've been shorting. I've been actively negative delta now. I have strong conviction that the market would turn to the lower side. However, the last week has just been ripping straight up. So it's been extreme pain, lost like 300 grand shorting. Again, I'm holding that until we have a bunch of down days. I think that the worst is not behind us yet, specifically when it comes to the ramifications of these rising interest rates on real estate and all of the different businesses tied to real estate. So I think we haven't seen the bottom yet. It's still coming. We're having a great rally right now. Seems like the Fed's like easing off a little bit. I didn't think the Fed would ease off of their, we'll call it hawkish tightening type behavior until at least the fall. That we will recover. Like long term, the market will be just fine. It may get a lot worse, but long term, 5 years from now, anything you buy, if you're diversified, will be just fine. So if you're buying this S&P 500, the Toronto Stock Exchange, the NASDAQ, whatever, it's all super, super solid. By the way, if you're watching this, I have an ask. If you're watching this right now and you're looking to invest in Florida, or you know people who are realtors down here, who have great off-market connections, or any wholesalers down here, or just know someone who wants to sell a property down here, have them reach out to me. I'm looking to build a deal pipeline in Florida, so hence the title today. That was my sort of ask. I'm partnering with someone right now we're working on trying to assign a 40 unit in Daytona Beach that we saw. It's currently under contract. It's under $100,000 a door. It needs a bit of love. Like there's no, it needs carpet and paint, but solid block construction, good wiring, good plumbing, newer roof, great parking lot and stuff, in really good condition. Not too far from the water, like 5 minutes to the water. Not a great area, like a sea. It's not like on a beachfront hotel, but some real potential there. When they're currently renting it at $400 a week to long-term people who are just staying there for like 6 months, a year, whatever. Some guys been there for longer. Transient people who can't come up with first and last, who are like, I can come up with $400 a week, which like is strange because you're basically renting out an efficiency studio suite with a little kitchenette and a fridge and a sink and stuff. And you're renting that for like $1,600 a month or more, sometimes $2,000 a month, depending on their rate. But $2,000 a month can get you quite a bit. But these people, it's the best for them. And so this is an interesting little hotel play. It is geared more to medium-term stays, but you could pivot that really easily. At being in Daytona Beach, could do well with shorter-term stays too, especially when you consider that you're getting it so cheap for under $4 million for 40 units. You're talking in the threes. Really interesting opportunity. So if you want to partner on that, we can do that too. I'll do all the work. You can just be passive. Ideally, assign it to someone who wants to take it down. I get to make a wholesale fee for doing nothing but passing paper. The partner and I, who we're partnering up on it, has it under contract. So if that's interesting to you, hit me up. If it's not, cool. Let's keep going with the live Q&A. Just throw your questions down below, and I'm happy to answer anything you might have a question on. What's been going on? I sold my sixplex that I talked about a couple of weeks ago for not a price that I am happy about. 1.15. I had wanted more. It's worth more. But my thought was the cash in my pocket can do a lot more for me than it could just sitting in the property. Like I have a bunch of equity in the property. We had a decision with the partner who I partner with on that. It's like, hey, the line of thought is like, do you just refinance it, go through all the work to refinance it, which by the way, would probably take me 20, 30 hours at least, and then a couple thousand in appraisals and other miscellaneous fees to get that all set up. And then months down the line, I'd be able to get a mortgage on there. It was an option, it was a valid option. Or we owned it in cash, so it's like, you can't keep the cash trapped in a property. Owning a property in cash is the stupidest thing you can possibly do, except for like 1% of situations. But in 99% of situations, cash is the worst thing ever. Owning the $6 in cash gives you like what, an 8% return? Let's say it's an 8 cap. That's best case scenario. In most major metropolitans, stuff's trading at a 4 or 5 cap for what it can currently sell for. So the question is, if you don't sell the property, you continue to hold it, it's the same as saying I would buy it at the current price. So that's why I always ask people, would you buy this property at this current price? And they're like, hell no, I bought it half this price 3 years ago. And it's like, okay, but it's worth this now. Would you buy it for this today? They're like, well, no, it's overpriced. Why aren't you selling it? If you think it's overpriced and you wouldn't buy it for that price, and you see other deals in the market that are better priced, someone like myself, people are calling me all the time. Like people calling me for like bungalows in London, like $400,000 or $500,000 that are duplex, beautiful properties. They're $100,000 under market value. All day long, I can pick up 2 of those and make 200 grand. I can recycle my capital. Instead of holding a project, I can do recycling through basically flips or burrs. I can recycle my capital. I can double it every 2-3 years. There is no long-term hold that doubles your money every 2-3 years. It just doesn't happen. And so I can do more actively with my money than I can passively. So that's part of why I'm selling. Still have a triplex, another triplex, and a duplex for sale in London for people who are wanting those. Two of them, I could also hold those properties. They're fairly well financed. One of them has a 2% mortgage on it, so it's not burning a hole in my pocket per se, and it is cash flow positive, a couple grand a month. But if you're looking for something in London, a house hack, both of the properties I'm thinking about selling are great house hacks. One of them has a guest house in the back that's detached, and then a duplex in the front. It's a huge lot, nice and secluded. The area is B-, but it's a nice, quiet, treed street. It is in East London-ish, sort of. So that's a downer, but again, not a horrible area. It's not like, in a really rough area of East London. There are pockets that are decent. This is in a residential pocket. So if you're interested in those kinds of plays in the 700,000s range, yes, I am live right now. I don't know if the Monster Pig, I don't know if the Wi-Fi is working so well in the hotel tonight. So it may or may not be streaming clear to you in 4K. Again, I'm on the 3rd floor and the Wi-Fi box is far. I did get the upgraded package for Wi-Fi. Actually, I don't want to toot my own horn, but I'm a platinum member at Marriott. So I actually get free enhanced Wi-Fi, but normally you pay like $7 for the enhanced Wi-Fi. And even that is fairly shit today, it seems, at this hotel. So unfortunately, this is where we're at. Hopefully you can hear me loud and clear. Hopefully it's coming in. I kind of wish it wasn't in 4K because I haven't shaved in a good minute, but or had a haircut in like a good year. I really should do something about that, but whatever. Did you make money in the market today? No. If you saw the start of the stream, you would see that I am actively negative delta the market. So I'm short the market. I do have some longs, but I am more short than I am long. So today was a very painful day. I think I was down. Well, the market's overreacting now on the short side, so shorts are having to cover. Thankfully, I'm not too deep on margins, so I don't have to cover anything. But I'm not short. So I have like a $4 million short position on the QQQ. It's going to get worse for sure before it gets better. We are not out of the woods by a long shot. Inflation is out of control. Interest rates are going to get worse. There are a number of factors that are negative. For the next 6 to 18 months. I don't see things trading outside of a band window more than sideways or down further. So for me, it's about hedging my position initially, and then I just acquired too many shorts on the way down. I was enjoying myself on those nice down days. People getting slaughtered. I'm getting making so much money. It's great. I wanted to use that profit from shorting to buy more long, right? Because the goal is long term to buy the dip. And I don't think we've dipped all the way, but we are in a dip right now, especially in tech, fintech, crypto, anything crypto related. Pretty much any stock is down year to date. There's a few exceptions to that, but pretty much every stock year to date is pummeled. Anything that I really like. So let's see here. First again, hey, welcome. Sam, how you doing? Okay, so it's coming in clear. Hi, Mike. Are you and your family doing well? Yes, doing well. Thank you for asking. We've been enjoying ourselves, and I've been putting a little bit of sweat equity on a property that we have here in Florida. My brother, he's all set up to finish and tee that project off over the next couple of months, and then we'll likely get it listed. So if you're looking for a Florida property as well, this is a property with an in-ground pool, has a guest house, oversized 2-car garage, shop, pull-through driveway with an RV, covered RV port, nice outside Florida room, and it's a 4-bed, 2-bath plus a 1-bed guest house. So 5 beds total. We're working, it's a couple of acres, about an hour to each of the beaches. So if you're going either East Coast or West Coast, it's a cool little jungle vibes type property, lots of palm trees and things. So very secluded off a paved road, which is nice. Yeah, so if anyone's interested in that, about $250,000, get yourself a nice little Florida estate for yourself and maybe share it with someone. It's big enough you really could. So that'll be an interesting little property that we'll turn around and make a little profit on. So hit me up if you're interested in that in the next few months when it gets finished. Hello, Nico from Ottawa. Don't forget to hit the like button. That's right, 100%. Thank you, Mr. McKell, for that one. Okay, someone says, you do understand that there is $1 trillion in buyback monies in the waiting. Yeah, I mean, there's a ton of money sitting on the sidelines right now, and there's fear, a ton of fear in the market, and that we will have relief rallies on the way down. Unfortunately, we're not anywhere near where I think the bottom is. Specifically in several sectors, there hasn't been near as much pain as I think is warranted for how crazy inflation is right now and how hard it is for most businesses without the ability to pass that on to their consumer. It's going to eat into margins, so we're going to have some really bad earnings quarters short term. Also, as they continue to tighten, there'll be less and less stimulus, right? We're coming out of this COVID era where money was just being printed, right? We're just like, it's fun. That results in inflation. So they need to tighten, which means they need to stop stimulating the economy, and they need to basically raise interest rates to combat inflation to the point where the demand drops. So where people are like, hey, I don't have money to go on vacation. I don't have money to buy that car, buy that house, to buy that stuff that I don't need, that they didn't need in the first place. But that's what they're trying to do. That will crush demand. Also, at the same time, what we'll see in the next 12 months is the supply chains catching up, hopefully. And so supply side, we'll see some fixes. Hopefully the combat in Russia ends. I am long some Russian index plays that are currently halted that aren't trading. So that'll be good. Someday it'll be great. It's trading for pennies in the dollar. And I thought, hey, Russia's going to be fine long term. They're a huge nation, one of the biggest in the world, actually. And so to discount their economy and say it's worth nothing because some sanctions, let's not forget that NATO literally comes in and bullies the shit out of Russia, right? I don't want to get political, but like creep in all the way around them and basically are bullying them, right? So they're trying to defend themselves. There's been previous treaties that are now broken. So it's like, there's a whole bunch of political shit. I get that NATO hates Russia and they're bullying and they're getting together and sort of bullying Russia. But long term, Russia has a huge population and is the largest country in the world, I believe. So lots of power there. I think that, potentially buying a little bit of long Russia might not be a terrible idea. I'm actually pro all the emerging markets. So I love India. I love Brazil, Russia, India, China, right? So BRIC. I'm all about those emerging markets. I do have those long in my portfolio. I think they're going to perform much better than the US economy is going to perform over the next 25 to 30 years. So long term, I feel much better about those markets than I do, say, the S&P 500. That said, I still have a large portfolio of S&P 500, mostly tech type plays. So more NASDAQ actually. But it's good to be diversified, right? Okay. Should go long. I am long, but I'm very much hedged on my long positions to the point where I'm basically, I was neutral until I added some more shorts recently. I've been slightly positive delta for a while now. So I'm waiting for a bit of a rundown. I get that we have a relief rally right now, but I'm waiting for the next down leg to close out those shorts. So worst case, I'll get assigned and I'll literally own short shares, the NASDAQ. So it's not levered, it's just short the NASDAQ. So the next time it dips, I'll just unload those, no big deal. And at that time, when I unload for a profit, I will then switch from short to long because I'll take the profit and all that capital I just freed up that was short and go long. And it'll be, when those are in profit, the market will be in complete pain and I can use more capital to buy in on that dip on the bottom. So yeah, no big deal. And worst case scenario, I'm wrong and my timing is off and I end up making 30% as the market recovers instead of 35%. You know what I mean? Like, I'm not gonna be able to time the market perfectly. No one can. Anyone who says they can is a liar. Historically speaking, almost no one over a 30-year period outperforms the index. Just remember that next time you try to outperform by being a trader and try to outperform the index. We all try, we all have fun, we dabble. I try to match and benchmark the indexes as best I can. Sometimes I outperform, sometimes I underperform. It's key to be diversified though, because you never want to lose your shirt. Try to replicate the index as best you can, or just hold the index, or trade the index, I guess, if you wanted to. But statistically speaking, even using options contracts, trading the index, though it provides nice cash flow. Again, with options trading, you can get really nice cash flow consistently on a monthly basis, creating almost like a dividend type portfolio using options, but your total yield will not be higher than just buying and holding over a 25-year period, statistically speaking, for 99.9% of traders. Okay, so Andrew says, I have a chance to build a purpose-built semi-duplex, 4 units severed on a lot. Would get to 6 units total, or would you buy a couple properties and build triplexes? It depends. There's no clear-cut answer, right? Like, on one side of the equation, there's the niceness of, or the pro of having all of the units under one roof. That's really nice from a one roof perspective. You have less roofs to fix, less heating systems to deal with, less plumbing to go wrong. 6 individual houses will go wrong versus having one stacked, right? So it's just more efficient, utility-wise, maintenance-wise, ease of property management-wise. It's all in one place. That said, 6 units stacked isn't as nice as 6 units side by separated houses. It's much nicer to have detached spaces, so you get a higher quality tenant profile and likely more rent as a result of that. So the answer is it depends. It depends on the price. Have you run the numbers on it? If there's a significant premium, or if it's the same price, let's say, to build 6 altogether or to build them spaced out, I would always go spaced out, because spaced out is more valuable. It creates a better caliber of tenant. So, and it just depends on the numbers. To me, real estate is mostly about the numbers and not the emotion behind it. But I can understand how there are different levels of tiers to real estate. So like an A tier property in an amazing location will always have a shit return ROI or cap rate for your capital, because you're owning a nice property of nice tenants. It's a nice building. So on the surface, it will have a lower return. There's just so many investors loving those tenants properties. They pay a premium for the land, and the land doesn't cash flow you, right? It's the buildings that's cash flowing you. However, in a depressed area, you'll have many unforeseen costs, like a tenant, the police break in, you get a lower quality tenant, police break in and bust your door open, going after a bad tenant, and tenants destroy the unit. And that happens a lot more frequently than in an A property. Almost never on an A property, but it will happen a lot on a D-class property. So you've got to factor in yes, the cap rates get much better as you get into worse areas of town, but it comes with all the headaches and the bullshit and extra costs associated with that sometimes. Not always. I know some really great operators that operate in the slums, and they do fairly well, and they place really good tenants, and they fix their units up nice, and it all goes well. Just a higher likelihood of that happening, and more the neighbor riffraff is just higher chance of theft and higher probability of negative events happening. And then in a recession, trying to sell said property in a worse location is a little bit more difficult, can take a little bit more time. So yeah, liquidity might be a little bit of a challenge, but with real estate, most of us aren't looking for liquidity. We're owning cash flowing properties that produce cash flow for us, and we're not looking to sell them immediately. Most of us who are buying and holding are 5-10 years out from when we're looking to exit. And if we have to exit over 2 months or 6 months, not a big deal. So yeah. Monster Big says, you're right about a bad recession. The yield curve inverted for several days now, but that bad recession is a year away. No one knows is the actual truth, right? We're in a bear market for at least the next 18 months. We will have relief rallies where things will be great. We will have times where it's not great, right? It really depends on, a lot of it's gambling, right? Like, what is the Fed going to do? Are they going to raise interest rates 1%, 0.75%, 0.5%? A lot of it comes based on factors like the jobs reports that come out. Are companies laying people off? Are they hiring right now? Month over month, how is inflation differing from last year? All of these macro factors come into play, right? And so we've been needing a relief rally, so it won't surprise me if we go through another relief rally. It could be 5-10%, who knows? I will continue to stay relatively neutral. I'm not ready to be long yet. That said, you could go long right now and it'd be safer than being short. Over the long term, shorts lose, right? Like over the long term, the market just goes up. But, right? But in the short term, I'm not feeling so great about being long. And I'd like to get in at a bigger discount. So we'll see what happens. I could be wrong, in which case, I'll switch to long and I'll ride it back up and I'll have 5% less gains because I was shorting, whatever. At the moment, I'm 5% ahead of the market. So if it keeps rallying 5% more, well, it is what it is. Good evening, William. How are you doing? I'm going to keep this stream short, by the way. It seems like there's not a lot of questions, which is fantastic. I don't know if it's because my internet is shit here in the hotel or if it's because of the titling of my video. Not a lot of my followers probably are from Florida or have anything to do about it or know anything about a deal pipeline. But if you do, by the way, I'll throw this out again. If you know anything about Florida or you know someone who knows something about Florida, reach out to me. If you're interested in investing in Florida, reach out to me as well. I'm just looking to build that network. I want to have a network of people who are, people who have capital to close on deals, people who know of deals, wholesalers, realtors. A lot of stuff changes hands off market, especially right now where interest rates are so high, like at 6%, the buyer pool for real estate has gotten super small. And there are a lot of properties that are still trading at their old cap rates from January, February. The prices haven't changed at all. And they're expecting people now they used to be able to qualify for a 3% mortgage are now qualifying for 6.5%. So the cash flow is gone. And so that makes the buyer pool very small. The bet is in buying real estate right now is that interest rates are going to fall. And so when those interest rates fall, you'll be able to refinance the property and you'll be cash flow positive. Be careful. Don't buy properties as a speculator. Again, we buy for cash flow. It's super important to be able to have that positive cash flow and to reduce downside if we have to hold for a long period of time. Remember that holding for a long period of time guarantees a profit in real estate. Over the long term, you always win. In the short term, you can lose, right? In a 1 year period, it could be bad, right? Let's see. Good article today in Bloomberg. Former Fed governor said they likely go to 4% and hasn't priced in yet. Not sure, but 2023 looks a bit rough. Yeah, I mean, the market is pricing in quite a bit of turbulence, but you're right. There's, I think there's more pain to come. And so again, that's the reason I'm pretty much delta neutral. If you go across my entire portfolios, I am currently neutral, exactly, I think. I might be a little bit short. Everything's covered, but I'm covered enough that it's selling my stuff at pretty big discounts because I wanted to protect myself in case the market drops 10, 20%. All of my covered calls protect on my long positions. So I have $1 million in Amazon shares, but I'm also short $1 million in Amazon shares using options contracts. I sold calls. So as long as Amazon stays over 108 a share, my shares get called away. So if it goes below 108 a share, then yeah, obviously. Interest with the Fed raising rates today as a buyer with gunpowder. Are you buying or in a few weeks later? I think, again, if the right deal comes along, I can negotiate some pretty sweet vendor financing, which we're looking at in some cases where the vendor will provide a 5-year, 3% interest mortgage to get the deal done. Okay, in 5 years, I feel really good about the price of that property. I feel like it'll be a lot higher than it is today. We're buying at a bit of a discount today. It could go lower, who knows? But if I'm locked in and I'm cash flow positive, I'm making, say, 20% cash on cash return, even if it doesn't appreciate in 5 years. I've made 20, 25% on my money every single year compounding for 5 years. Because again, the vendor is providing 3% cost of debt or 4% cost of debt. So where there's vendor financing in play, very attractive. Yeah. I'm gonna wrap this stream up a little early today, I think. Unless there's one more question. Okay, one more question. Is it easy to get financing as a Canadian trying to purchase a property in the States? Also, Canadian bank or American? It depends. You can use Canadian banks to buy your first vacation rental property. RBC, BMO definitely does it. TD, they go there and they will finance. So that's important to know. The other thing is, if you're buying larger multifamily, there are banks right now. I know a bank, if you're buying, say, in Daytona Beach, and you want to buy or get assigned the 40 unit that I have under contract, I can line up financing at 65% loan to value at 5-6% interest with a bank there. So you get about 35% down. They would lend to a Canadian as well. So yeah, there's definitely financing options that exist. Yeah. All right, everyone, I'm gonna wrap the stream up. I am in a hotel and I do want to go for a swim in the pool. So we'll see you next week. You guys know where to find me on Instagram at Mike Rosehart. And yeah, thank you so much for tuning in tonight. And if you're watching the replay, hit a like and find me on Facebook. Bye, everyone.